Let me introduce to you Samantha Fitzgerald. Samantha is an attorney in plantation, and her firm is 100% focused on estate planning and probate and trust administration. She's been practicing for over 20 years, hard to believe. She's a CPA and has an LLM in tax. Welcome, Samantha.
Thanks, Bianca. Appreciate the warm introduction.
You're welcome. My name is Bianca Moreras, as we just said, and I am your host and moderator. I am a business development and career transition consultant and coach. I bring almost 40 years of experience to the table with concentration in law firms and working with attorneys with the ability to help any company get to the next level. Everybody, welcome. And we're going to get started. Today, we're going to talk about one of my favorite topics, which is tax issues in estate planning, trust, and estate matters.
Very exciting.
Very exciting. Oh my gosh, what a great topic. So without further ado, let's talk about what kind of taxes are there anyway, Samantha?
So this is always a confusing topic for most people. So there are a few different types of taxes. And when people ask tax questions, I know that they're not even quite sure what they're asking about. So there are income taxes. So that's probably the most familiar tax. You know, people pay income taxes themselves. A lot of people don't realize that estates, and when I say estates, I'm really referring to a probate administration in this sense, and trusts. So there are estates, probate, and trusts. Also pay income taxes. And then there are estate taxes, both federal estate taxes, and some states impose an estate tax. And then there are inheritance taxes, which a lot of people assume are paid. I get a lot of questions about inheritance taxes on the receipt of the funds. There is no federal inheritance tax, so it's only imposed by some states. Not very many states have an inheritance tax. So for instance, Florida has no state estate tax, and we have no inheritance tax either. And then there are capital gains taxes, but those are really income taxes. So that falls under the income tax umbrella, but it's calculated differently than regular ordinary income for income taxes, but it is really an income tax. But a lot of people know the term capital gains tax. And then if you're uber wealthy, there's the generation skipping tax, because the government, the federal government, doesn't like people to get cute and try to avoid estate tax by giving their estate down some generations and skipping over. We want to tax you at every single level. And then there is a gift tax, which is sort of similar to the estate tax, also at the federal level. And some states impose a state gift tax. So those are all the different types of taxes. There's different tax forms for all of them, which is very confusing for people as well. Most people are familiar with the 1040 return. That's for your personal income taxes. Sticking in the estate and trust arena, an estate or trust files a form 1041 for income taxes. And then there is a form 706 for federal estate taxes and a 709 for federal gift taxes. I don't know what the form numbers are for the individual states for their estate and gift. But so, as you can see, just from the opening question, this can be super duper complicated.
Yeah, I'm glad we have you to steer us in the right direction, Samantha. So what about probate? Will my estate be a tax if it goes through probate?
No, so that's a common misconception. I hear that a lot from people where they say, oh, I need to avoid probate because otherwise my estate is going to be taxed. And that's just not a thing. not a thing at all. It's just a completely incorrect statement. Going through probate is time consuming and costly because you have to pay lawyers and there are court fees, and sometimes your estate ends up paying creditors that might not have been paid otherwise. But probate in and of itself does not trigger any taxes that otherwise would not have been paid anyway.
Well, thanks for clearing that one up. But will my estate avoid tax if I have a trust?
Similar issue. I'm going to say no, although that can be a very complicated question. But your typical standard trust that most people use for their estate planning, which is irrevocable trust with an R, meaning that you can modify it and amend it and terminate it, that does not save any sort of taxes at the level of the estate. So somebody dies and they have a trust, it doesn't go through probate, that does not save any sort of taxes at all. Now, there are other kinds of trusts that somebody might use, mostly to avoid estate or gift taxes, or reduce, I should say. Not really income taxes. So income tax is probably the most common tax that most people are going to pay, inclusive of the capital gains tax. Very few estates are subject to an estate or gift tax, because right now the exemption is a little bit over $12 million per person at the federal level. So for a married couple, you've got at least $24 million of an estate that's not going to be taxed at the estate tax level. Now, you may pay a boatload of money in income taxes. So trusts can be used to reduce or eliminate the estate tax, but typically not income taxes.
Oh, my head is about to burst any minute here. So if I have a brokerage account, how is that taxed at death?
So this is a little freebie that a lot of people benefit from. So when you have an asset that could be subject to the capital gains tax, so that's basically anything that would appreciate in value. So it could be real estate, it could be a brokerage account with stocks, maybe bonds, any sort of asset. It could be usually not cars, but it could be maybe a classic car or some sort of asset that may appreciate over time, meaning that it becomes more valuable over time just because of the lapse of time, not because it's generated, income, or you've put money into it or something like that. So generally speaking, when you're alive, you have an asset, you buy it for $100. If 5 years from now it's worth $300 and you sell it, you're going to recognize $200 of income, capital gain income, the difference between what you sold it for and what you bought it for. Now, what we really call it is adjusted cost basis, because if you put some money into it, so let's say you buy a property, an investment property, and you buy it for $100,000 and you put a $100,000 roof on it. So it's a $200,000 cost now, and you sell it for $300. Well, your capital gain is only $100 because you've put money into it. So it's called adjusted cost basis. So when you die, those types of assets get what's called a step up in basis. So the new adjusted cost basis becomes fair market value at the time of your death. There are some slight exceptions to that, but for the most part, that's what happens. So when you die and you pass your assets up to your heirs or beneficiaries at death, you are completely escaping all the built-in capital gain in those assets. So sometimes people will come to me and they say, well, I have plenty of money. I just want to give this house to my daughter because she's living there. Or, I want to transfer some stocks to my kids. And these are things that they've owned for a while. So we have that discussion. Well, we have to go through and decide, is this something you really need or want to do now, or can it wait until you die? Because they're going to get a huge tax savings if you pass it at death, as opposed to if you pass it now. Because if you transfer it while you're alive, it gets a transferred cost basis, transferred adjusted cost basis. So it's as if, you know, the person you gave it to bought it for the same price that you bought it for. So you don't get any step up making gifts, but you do get the step up making when you pass it upon death. So that's a huge advantage. So anybody that doesn't have an estate large enough to be subject to estate tax, they're going to get the benefit of that step up in basis. So most people are getting that benefit, and it's really a huge benefit. The government has tried to do away with that at one point. That was probably before I was practicing, I think. It was a huge disaster. They've talked about doing it again, but it's never actually happened. Nobody knows, you know, what will happen, but I don't think it will happen again because it was such a huge disaster the first time. Imagine trying to figure out, you know, what maybe your parents paid for some Apple stock 30 years ago. You know, so the record keeping is impossible. So I don't think they'll do away with that again. So that's really a huge benefit. Not everything qualifies for a step up in basis. So things that would be subject to regular income tax in the hands of the decedent. So the most common thing are retirement accounts. So even though they are similar to a brokerage account, you invest in stocks and bonds and mutual funds, your own account, when it comes out, when those distributions are made, you report that as regular income tax, except for a Roth IRA or a Roth 401k. That's different. But a regular traditional IRA or a regular traditional 401k, you're going to report the full distribution, 100% distribution, not just the income, but the full distribution on your tax return as income. The same thing applies to your beneficiaries. So those types of accounts are not eligible for the step up in basis. Something to be aware of with the step up in basis, it's really important that you figure out what the fair market value of these assets are at the time of death. So that can easily be overlooked if you're not aware of this, or if a professional doesn't make you aware of it. You know, mom dies, you inherit a house, maybe it was a life estate deed or something, so it didn't even go through probate. Maybe you didn't even have a lawyer, it just passed to you and you went about your merry way. You know, maybe you rented the house out, or maybe you lived in the house for a while. You know, something happens and then you go to sell it, and, you know, what's your adjusted cost basis? How do you report that on your tax return? So it's really important for people to be aware of this so that they figure out what is the fair market value at the time of death. You got to get an appraisal, or you have to, you know, get the date of death values for stocks. These brokerage companies are getting a little bit better now. They are now required to keep track of the cost basis of the holdings in these accounts. Back in the day, you would take over an account and it may have switched hands a couple of times. Nobody had a clue, you know, what they paid for these things, or what the date of death value was if they changed hands that way. So now they're getting a lot better because they've had rules imposed upon them. But still, if you inherit stocks, real estate, anything along those lines, figure out what the value was at the time of death and make sure you have that in your records. Very important.
Wow, that was such a great tip. It was a lot of information, but you did such a great job about that. And yeah, a little excited about that. Well, let's take a different turn. If someone has a green card, how is their estate taxed?
Okay, so this can be tricky as well. So when you have a green card, you are considered a U.S. person for income tax purposes. So you file your regular income tax return, you pay income tax like every other U.S. person. But estate taxes has a completely different set of rules. So federal estate tax is based upon domicile. And domicile is a facts and circumstances test. So you can have somebody that, you can't have somebody with a visa and be domiciled here, because one of the main the main test with domicile is that you have you view this as your tax home. You have an intent to stay here forever. So there is a whole list of factors that you look at to make that determination. So it's very interesting. So with a green card, you could potentially be domiciled here, but maybe not. If you're a citizen, you're automatically taxed as a US person for estate tax, whether you live here or not, doesn't matter, unless you've expatriated, which is a whole different story. So let's say you have a green card and you're, going about your business, you live here, you have a family here. Are you subject to estate tax? Well, it depends. So it gets very gray. So you may clearly say, oh yeah, I intend to stay here forever. Okay, but now you have to prove it maybe to the IRS. Or you may say, yep, I've got a green card and I've been here for 30 years, but as soon as I'm done with whatever business I'm doing here, I intend to go back to Germany, my home country. You're not domiciled here. You're just here temporarily. You're a resident, but you're not domiciled here. So it's a slight but very significant difference in the analysis, and it's a huge difference in the outcome. So I said earlier that we have this, a little bit more than $12 million estate tax exemption, federal. Well, people who are not domiciled in the United States get a $60,000 exemption. Hugely different, obviously. So we've had to give, the bad news to families. Somebody dies, they're not domiciled in the United States. They have a $100,000 condo, right? Nothing. There's no liquidity. There's just a condo. It's not even worth a lot of money. Guess what? They're going to pay a very high rate of tax, 40%. It's a graduated rate, but it goes up on $40,000 that they are not expecting. So imagine if they have a $500,000 house here, that maybe it's a vacation property that they come here. So that can really, really, really catch people off guard. That figure has not changed my entire professional career, yet the other exemption, the for US people, has gone up dramatically. I think it was probably 600,000 when I first started practicing, and now it's over 12 million and set to go up to almost 13 million next year. So that can really catch people off guard. Anybody in the real estate world needs to be aware of that, because, foreigners come and they buy property here and they have no clue about this tax trap that they may fall in.
Wow. Wow, that is definitely a trap. Oh my goodness. Well, okay, so let's take another scenario. If someone is a US citizen and their spouse is not, is there anything they should be aware of?
So this can be interesting. So the US spouse, if they die first, they can leave, they still have their $12 million exemption that they can, leave their assets to. What they don't get is the unlimited marital deduction. So US people can leave $100 million to their spouse tax-free. So they don't get that, but they still get, a very large exemption. Now their spouse, when they die, so even if they left the 12 million to their spouse is, only going to have that $60,000 exemption. So there's something called a QDOT, a qualified domestic trust, that you can use to delay the tax if you wanted to leave it in a trust structure for your non-citizen, non-domiciled spouse. They're not done all that often. International tax is really quite a specialty. So most lawyers don't dabble in that. You're going to go to a lawyer that's pretty much all they do. But that is a tool, that some people might use. You just don't see them very often.
Okay, well, my gosh, let's open it up. Does anybody have any questions or situation or a scenario that you know about? You could put it in the chat. You can raise your hand. This is all just so very interesting. It's not an exciting topic, Samantha, but it is so interesting, at
I
least to
think it's
me.
exciting.
Well, you think I think it's exciting. I don't know about anybody else. How about you, Stephanie? Do you think it's exciting? So I don't want to put anybody on the spot because we do have time. I don't know. Anything else you want to explore here, Samantha? Any story you can tell us that went from disaster to good outcome because you helped someone?
Well, by the time you're seeing stuff like this, it's usually already a disaster. So there's not too much you can do. One thing I will say, just so people that, are aware of it, is that, when do these returns get filed? So an estate tax return is due 9 months after date of death, and you can make a 6-month extension. For those decedents that are not required to file because their estate is under 12 million. Sometimes, so there's a thing called portability. So each spouse gets their $12 million, but the surviving spouse can get both. So they get the deceased spouse's exemption that hasn't been used, plus their own. So for a married couple, it's $24 million. Portability is somewhat new, only created maybe 10 years ago. Prior to that time, you each had your own exemption and you used it or lost it. Use it or lose it. So portability is really changed estate tax planning significantly. But the only way to get the portability is to file an estate tax return. So we're doing that for a client right now. The husband died. His estate was only worth, a couple of million, so no obligation to file. His wife's estate is worth about 5 million. So, but she's still alive, she's doing well, and it's very, very likely that the exemption will go down in the future. So it's automatically scheduled to go down in 2026 to about 6.5 million, but there's been tons and tons of talk about reducing it, So what if it's 3 million by the time she dies? Well, now she has a taxable estate. Today she doesn't, but maybe when she dies, she does. So we're going to file an estate tax return simply to grab the unused husband's exemption and port it over to her so that she has a nice fat cushion, and will most likely never, exceed that amount. So that's really tricky. A lot of people could get caught off guard with that. So if the deceased spouse has a lower estate, hasn't used it all, and the surviving spouse may be over the limit at death, that's definitely something people need to look at. And I bet you there's been tons and tons of estates that have been overlooked for that benefit. So that's really big. And then there's the fiscal year option, which is more on the income tax side. So estates, so if you're in a probate administration, they typically file on a calendar year like we do, and trusts file on a calendar year. So January through December. Estates, and both estates and trusts file the same income tax return, 1041. But estates are allowed to choose a fiscal year, meaning they can say, well, I want my tax year to be from, June to June. It really be June 1st to like May 31st, or any combination. It doesn't matter what months they choose. It's just it can never be more than a year. So the first year always falls, slightly short. But this can allow you to do some income tax planning as far as when the income is included in the beneficiary's tax return. And an estate and trust are typically flow through type of returns, similar to an S corporation or an LLC or partnership, if anybody's familiar with any of that. A little bit different because in those entities, the entity never pays the tax. It's all flow through to the owner. But with a trust or estate, it's kind of like a hybrid. The entity itself, the estate or the trust, could pay tax, but if the income is actually distributed or is supposed to be distributed to the beneficiary, then it flows through to the beneficiary. So for instance, I could delay if the estate receives something towards the end maybe of 2022, but I chose a fiscal year ending in February. that doesn't get reported to the beneficiary until after February. So they kind of escaped an entire year. They've been able to delay the inclusion of the income and the tax in their personal return. So that's a tool that can be used. And then the portability, really important. And
Yeah, I
that's
don't know.
probably enough for today.
That's enough for today. And that was very sexy talk about tax, let me tell
Thank
you.
you. Thank
So
you.
I really like that. That's a good finagle. We love finagles. So, and we love bagels. No, I'm kidding. So we hope you enjoy this. I don't have any questions in the chat. I hope you enjoy this. We meet here the third Friday of every month. We do not meet the last 2 months of the year, November and December. We take a break for the holidays and we start right back up in January. So we will see you next month with a new topic. And please feel free to reach out to Samantha and her office at any time. They're happy to answer any questions. They're happy to set an appointment with you and also review any documents that you have if in fact you need to make a change or you haven't done your paperwork to get your you-know-what together in a long time. So any closing comments, Samantha?
Thank you, everybody, for coming. I appreciate it. Hope you learned something. Happy to answer any follow-up questions that you have, and have a great weekend.